G'day expats, today I'm just doing a short summary video on a recent tax determinations that came out regarding family trusts or discretionary trusts. Now trusts in Australia can be a great vehicle to hold different assets such as shares, property, as well as businesses, and that allows us the opportunity to distribute that income from those businesses or capital gains to different beneficiaries. It's a great vehicle to use to minimise our tax each year. Now when we hold these types of tax vehicles when we are non-resident, sometimes we need to be careful on the type of assets that we're holding in that trust, as well as the potential capital gains that we might realise, and how it's going to be taxed from a non-resident point of view. One item that we need to remember is that as a non-resident, our marginal tax rates are technically higher. We don't have a tax-free threshold. We pay 32.5% tax on the first net income dollar from certain Australian sources, and therefore we need to be mindful when receiving capital gains from a discretionary trust. The first tax determination was 2019/D6. Now, as a family trust that held shares in normal ASX blue chip companies, and as a general summary, it realised a capital gain within the trust, and as all the beneficiaries were non-residents, it made obviously the distribution to one of them, and because they're a non-resident, they had to pay tax on this at the non-resident marginal tax rates. Now, you compare that to a scenario where if that same individual held those shares in their own name as a non-resident, and they had purchased these shares whilst they were non-resident, or alternatively they had done a deemed disposal event on these shares, then it wouldn't have been a tax event in Australia. It wouldn't have been reportable under CGT, and therefore there wouldn't have had to be any tax paid to the ATO on that capital gain. It's mainly due to the fact that shares, managed funds, ETFs, as well as listed investment companies are treated as non-taxable Australian property. So that first determination should act as a cautionary tale for non-residents who are utilising family trusts. The other tax determination that came out was 2019/D7. Similar scenario. Family trust was holding shares in a company that was listed on the London Stock Exchange. Now that trust and the beneficiaries were non-residents. They realised the capital gain in this company that was listed on the London Stock Exchange, and because the trust was the vehicle that was being used to hold these shares, that capital gain had to flow back into the trust here in Australia, and they had to distribute that capital gain to the non-resident beneficiaries. Now, ordinary, we wouldn't have to pay tax on that transaction in the event we held them in our own name because we're a non-resident. Now, in that likely case, obviously they've realised that capital gain, the capital gain's flown through the trust, it's been distributed to the non-residents, and then they've had to pay a large amount of tax on that at non-resident marginal tax rates. So these tax determinations should act as a cautionary tale when we're using tax vehicles such as trusts or companies. Appreciate your time.